Hi there, my friend. Have you read the book The Intelligent Investor yet? If you haven't, it might be worth checking out to see if it sparks your interest. If you have read it, that's fantastic. A little refresher can always be helpful, especially if it's a book you enjoyed. So, let's get started. Introduction. 1. Investors versus speculators. Investors thoroughly analyze a company's value and prospects before investment. Speculators aim for quick gains based on predicted short-term price fluctuations. 2. Mr. Market. An allegory for the irrational, emotional nature of the stock market. It offers prices that may or may not reflect true company value. Part I. Investing and speculation. 1. Inflation and investing. Inflation erodes returns. Investors must aim for returns that outpace inflation to build wealth. 2. The defensive investor versus the enterprising investor. Defensive passive investors seek stable, low-risk portfolios, often with index funds. Enterprising active investors willing to devote more time and research to finding undervalued stocks with greater potential returns. Part I. The investor and market fluctuations. 1. Market fluctuations as an opportunity. Smart investors don't panic with market declines. They buy undervalued stocks. Resist the urge to follow the crowd. 2. Dollar cost averaging. Periodically investing equal sums, regardless of market conditions, smooths out the average price paid per share, benefits long-term investors. 3. Margin of safety. The difference between the price of a stock and its intrinsic value, its true worth based on assets, earnings, etc. This buffer protects the investor against uncertainty and errors. Part IV. Security analysis for the lay investor. 1. Balance sheet analysis. Understanding the financial position of a company. For 2 examples, focus on strong current asset to current liability ratios. Long-term debt should be reasonable compared to assets. 2. Income statement analysis. Understanding company profitability. Look for consistently strong earnings over time, not just recent quarters. 3. Simplified security analysis for defensive investors. Graham lays out specific quantitative criteria to help simplify the selection of sound investments for those less comfortable with analysis. Art V. The defensive investor and common stocks. 1. Portfolio construction for the defensive investor. Graham suggests a balance of stocks and bonds. Stock selection should follow his simplified analysis criteria. Part V. The enterprising investor. 1. Active versus passive management. Enterprising investors seek to outperform the market through in-depth company analysis. This requires significant time and knowledge. 2. Bargain issues. Severely undervalued companies, be prepared for analysis and potential volatility. Part V. Convertible issues and warrants. 1. Convertible securities. Bonds are preferred shares that can be converted to common stock. Offer potential upside with some downside protection. 2. Warrants. Long-term options to buy common stock at a fixed price. Highly speculative, only for experienced investors. Conclusion. The philosophy of investment. The intelligent investor focuses on thorough analysis to find long-term value while minimizing risk through a margin of safety. Don't speculate, don't follow the herd, and be patient. That's just a glimpse into the insights offered in The Intelligent Investor. I hope this gives you a sense of what the book is about. Happy to know if by any chance you decide to dive deep to the book afterwards. If you're interested in exploring other books and would like more summaries and you have spare time, please let me know in the comments. Thank you so much for listening.